Max, I guess I would ask what you might be looking for the situation to look more complicated from here. I mean, right now the market is saying we're going to get lower rates from the Fed, and it's not because we have outright economic weakness. It's almost an insurance policy, and we still have, a lot of the kind of more aggressive parts of this market, crypto, IPOs, meme stocks, et cetera, running. So what does that tell you about the sentiment setup?
Look, in terms of the sentiment, actually, the surprising thing to us was how hated this rally really has been pretty much since Liberation Day. When we look at, for example, our proxies of long-only sentiment, long-only investor positioning, long-only investors really have cut their overweight in equities after Liberation Day, and we're not even back to half that overweight, not even back there. High-yield credit, long-only investors have gone down, have downgraded high-yield credit to the most bearish since 2022. They've just turned neutral last month. So again, I think that's been a rally that was very, very much hated. We've seen that obviously in the last 3 weeks as well with payrolls. When payrolls came back, the last 3-4 weeks, we've really just spent our meetings with clients talking about how the labor market is perhaps not as bad as it looks. Jackson Hole was another sort of perhaps a stumbling stone really for risk assets, and particularly for the next couple of weeks. I think the next 2-3 weeks, I think there is a lot now clear. The next 2 weeks, let's face it, the next payrolls are only in 10 days. So the next 10 days in particular, I think we can see quite a proper squeeze higher, again, across the risk asset spectrum.
So you're of the view that, in fact, we may be seeing a little bit of greater firmness and maybe even a reacceleration in the economy here, because part of the premise of, the dovish turn from Powell was we're worried a little more about labor market risks.
Yeah, but I do see when we look at high-frequency indicators, in fact, it is quite interesting to see that high-frequency indicators for the U.S. have sort of shown this front-loading of activity in March, April. There was a bit of a dip in activity in May and June. And really what we've seen in the last 2 months since the end of June is things picking up, whether that's same-store retail sales, whether that's credit card spending, whether that Visa, for example, spending momentum index is up. Even on the labor market, the staffing index has been up. The weekly staffing index has been up the last 7-8 weeks. And that leaves also, for example, the Fed's aggregate weekly activity proxy up in the last 7-8 weeks. All of that actually tells us, look, the economy may actually be at least slightly reaccelerating, particularly, perhaps not outright, but particularly relative to very, very bearish consensus expectations for the third quarter, where once again, just like in the last 2.5 years, these expectations from consensus of a very, very sharp drop in activity for Q3 may not be fulfilled. And that, of course, that upside surprise, that tells us a bit more broadening in the equity market.
Yeah.